Separately on Bitcoin, we're now sitting in the $5,600 range. Obviously, it's come off of its highs. Are you buying more?
Well, we have been a net buyer, and we pick our spots over time. We pick our spots. We do not buy on spikes. One of the things that we're wondering, if we're right on deflation as opposed to inflation, there are many people who hold Bitcoin as an inflation hedge. Now, we think that it's still an important asset class, new monetary system. So watch what's going on in El Salvador. But there may be some people who sell at the margin because if we're right, inflation is coming down, less of a worry. However, we think longer term, it is as important an asset to protect against counterparty risk in the case of an 08-09 type of meltdown. It is also a very important asset class to protect against confiscation of wealth other than inflation. You know, in other countries, there are corrupt regimes. And so we believe there is going to be a very important place for Bitcoin as a rules-based global private monetary system, the likes of which we've never seen.
But in terms of where we are right now, are you saying, okay, great entry point for certain people, for yourselves? Are you thinking this is going to, some people look and think that 53,000 is some kind of new thresholds, and maybe it falls a little bit farther. There's others who think it's about to pop up again after Thanksgiving. Everyone's going to sit around their Thanksgiving table talking about Bitcoin again.
Yeah. So Yassine El-Mandra, our crypto analyst, crypto lead, has developed on-chain analytics with others in the industry, which are actually flashing more green right now than red in terms of a point. I can't tell you what we're doing on any particular day, but the on-chain analytics, on balance, we go through them quite often, but at least once a week. They are flashing more green than red. Right. So that I would be more bullish on balance right now than I would be bearish. Greetings, everyone. Well, it certainly has been a pretty wild time in the market, and we are here for you in terms of communicating what we know or what we understand at the moment, and that's what I'm here to do. You know, I've been getting the question, what keeps you awake at night? I can tell you honestly, the one thing that keeps me up at night is that as the market goes down and our strategy is punished disproportionately, what keeps me up at night is knowing that some people are going to panic if they're looking at their accounts on a day-to-day basis. You know, we keep saying almost every time I talk, I say we have a 5-year investment time horizon. At the moment, we are close to, from an expectations point of view, a record in terms of what we expect from our portfolios during the next 5 years at a compound annual rate of return. I've seen it only higher once, and that was after the rout in the fourth quarter of 18. And based on our expectations at that time, we believed that our portfolios would deliver a compound annual rate of return of 42%. So that's 42% over 5 years. That's more than a quintupling. We're just about there again. So again, ahead of just spectacular growth rates, exponential growth rates associated with the innovation platforms, so DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. And even more importantly, the convergence between and among those platforms. We believe that our companies, from a revenue growth point of view and ultimately a profit growth point of view, are going to show exponential growth rates. And we would assume, now we may not be right, but we would assume that the stocks would award them or the market would reward them accordingly. So with that said, just let me talk a little bit about FUD, fear, uncertainty, and doubt, in a market when Chairman Powell, Federal Reserve Chairman Powell, sort of changed his mind from inflation is transitory to perhaps it's not transitory. I think that has unnerved the markets. and we've got investors and analysts fleeing back to their benchmarks. Our strategies typically include stocks that are not in the broad-based benchmarks. And so our stocks are the ones they sell in order to move back into the benchmarks. I've been through this time and time and time again. This is no different. And so we usually do the opposite. We know they're throwing our stocks out, and therefore, instead of trying to get close to any benchmark, and as you know, we don't have a benchmark. We're looking to the future, not the past. We concentrate our portfolios towards our highest conviction names, toward those stocks that have been punished disproportionately, and we believe unfairly in the marketplace. And just to give you a glimpse of what I mean, our portfolios, our strategies have been associated with stay-at-home stocks because they treated us so well during the coronavirus crisis. But the point we've been trying to make is that the world has changed permanently because of the move towards increased digitalization. We're not going back. And therefore, we think that you should start thinking about these stocks, not as stay-at-home stocks, but stay-connected stocks, stay competitive stocks, stay globally competitive stocks, because that's what we do. We're focused on the way the world's going to work, really transformational growth. Well, the labor force, believe it or not, is shrinking. That is a very curious thing when we have more than 10 million jobs going unfilled right now. What is going on? And this was part of our discussion this morning at our brainstorm. The topic of DeFi and DAOs, distributed autonomous organizations, and NFTs came up. It seems as though there are a lot of people who have become a part of this movement. Many young people who graduated from terrific colleges are leaving their engineering and other jobs at Google and Facebook and Amazon to pursue this dream. And they don't even know really where they're going. They're experimenting, they're exploring, and they're trying to find their way in this new world. It's really could define the future of work, where it will be itemized. You have the scale of the internet to support new distributed autonomous organizations. We think while it's somewhat difficult to understand right now, it will become clearer. I always say follow the developers, and that's what we're doing. And they are scrambling into this new world much more rapidly than they scrambled into the internet, I believe, in its early days, or I know, again, because we do watch the developers. That could be causing significant distortions in ways that we won't understand perhaps for years. And certainly the economic statistics are not going to keep up with this. They're going to be revised and revised and revised until the government really has a handle on it. And that could take 10 years. We're probably going to continue to be puzzled by employment reports going forward. Interestingly, in this report, while non-farm payrolls, which really is a survey of corporations, establishments, that metric disappeared. Household employment, which takes into account more small businesses, mom and pop, self-employed, that metric was up 1.1 million units. That's a very strong number. I would not consider this employment report weak. And in fact, there was another metric in it that I found very interesting. The average work week up about 0.5%. That's a very strong metric, and it more than offsets the disappointment in non-farm payrolls. So if we look at average hours worked for the fourth quarter, just kind of get a sense of what that's going to be, it could be more than 5% at an annual rate. Now, if you slap a little productivity on top of that, you could have a 7% real GDP growth quarter, which would be phenomenal. But somehow the market isn't very excited by this. Now, why might that be? Before I get there, I'll just mention one other metric in the employment report, average hourly earnings. They disappointed on the low side of expectations. They were up 0.26%. Expectations was were 0.4%. And on a year-over-year basis, they're back down to 4.8, having touched 5% in the original report. So that's interesting because those who are fearing inflation remember or have read about the wage price spiral that plagued the US economy and many other parts of the world in the 70s. Well, that's not happening, at least not yet. So that's a very important number. And oh, by the way, 4.8% on a year-over-year basis. If we are right and productivity is going to move up 2 to 3 to 4% in the next few years, we should have wage growth in that range as workers become more productive. One thing I will say is, given the massive amount of innovation taking place right now, that is going to be highly disruptive. We do not believe that most asset allocators have enough allocated to innovation. And I think that the traditional benchmarks talk about risk because of these innovation platforms, DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technologies, because those are going to rip through the traditional world order and disturb it mightily, that those benchmarks are probably where we're seeing the bubble today. I know what I find so interesting about movements in the market today is the fear of interest rates and inflation picking up really started in February of this year as people were getting vaccinated. And the markets went after our strategy to express the risk and basically shorted our strategy. What I find so interesting about this is that the market's multiple, broad-based market, so S&P's multiple on next year's earnings is at 24 times. NASDAQ's is at 31 times. These are near record highs, except for the tech and telecom bubble. If inflation is really the risk out there, why isn't the entire market's multiple coming down? I remember when I started in the business, late 70s, early 80s, Art introducing me to Capital Group on the West Coast, and I'll be forever grateful. Back then, I think by the end of the bear market in 1982, the market's multiple was down to 6. I just mentioned that we're up to 24 on that basis right now. Now, you're going after multiples in our space, and what has happened, the depreciation in our stocks from mid-February to today has not done anything to our forecast. We're now just getting our forecast. We're now just getting our companies and our stocks at lower prices. So in mid-February this year, as we did our 5-year forecast, and we assume massive multiple compression during the next 5 years to something like FANG multiples, EV to EBITDA in the 18 to 20 range. When we did that in February, at the peak of our strategy, the compound annual rate of return we expected from our portfolios was roughly 15%. Today, doing that analysis, some of our projections have increased. The compound annual rate of return we are expecting is close to 40%. So in February, we were expecting a doubling over 5 years. Today, we're expecting nearly a quintupling over 5 years. So I think the platform that has been hit the hardest in this correction is the genomic revolution. And the reason is many of these companies are losing money. We're in this is a movement in its infancy. And I think the most exciting thing is we can now isolate mutations in and among our 6 billion bits of code in our genome. So 3 billion base pairs, 6 billion bits of code. Until recently, we could not isolate those mutations. Mutations are the earliest manifestation of disease. And now what we're beginning to understand is the convergence between and among DNA sequencing, artificial intelligence, and CRISPR gene editing, as well as other gene therapies, is curing disease. We have functional cures now for beta thalassemia, sickle cell disease, ATTR. Now, these are blood-related diseases, but the companies involved are now focusing on some of the most complicated diseases like diabetes. And what we're learning from companies like Freenome, which is a private company focused on the convergence of AI and DNA sequencing, we're learning that the body sets up for disease, and that artificial intelligence is able to discern when that setup is taking place. So wouldn't it be wonderful to discover cancer in phase 1 or stage 1, or maybe even before it starts, before the cells start replicating? So the genomic revolution fund that we run has been hit very, very hard this year. Now, it had a magnificent last year, up 180%. I think it's down 35% this year. We're probably more excited about that opportunity in terms of how it's going to transform lives. What's going on is tax loss selling. That's just a technical factor. Beyond that, I think that the fear of inflation and interest rates rising, especially after Chairman Powell declared that perhaps inflation is not transitory here, has scared the financial markets. This really started in mid-February, this correction. So this is a very long correction for us. We actually think the bigger risk is deflation by far. I disagree with Barry completely on this, and I look at these rent increases as major tax increases effectively on the lower income earners, and the same thing with gasoline prices. The University of Michigan Consumer Sentiment Index is lower now than it was at the depths of the coronavirus. Why? Because purchasing power is diminishing here so much. I also think that businesses that have spent the last year and a half scrambling to catch up with consumption, they were way behind, are now overdoing it. And we are in the middle of a major inventory build that is going to unwind next year. So that will be a cyclical deflation. And then innovation itself is inherently deflationary. We're seeing, just to give one example, artificial intelligence training costs dropping 60% per year. Right? And AI is going to permeate every sector, every industry, every company. It's going to become, very competitive. So we think, and that's just symptomatic. There are so many other deflationary forces out there associated with DNA sequencing, robotics, energy storage, blockchain technology. So, and what we're also seeing is the convergence between and among these various innovation platforms, so that one S-curve is going to feed another and another. And so people are saying, well, then why are these stocks going down? The question we used to get is, we're in a bubble, aren't we? I said, we're not in a bubble. And now that our stocks are down, but the averages are up, many people are thinking we're in a bubble still. And we are, and it's called the benchmark stocks, which are going to be disrupted as the traditional world order is disintermediated and in often cases is going to be destroyed by this new world. So you can say I'm talking my book, but those are two massive secular deflationary forces. One is extremely positive. Deflation, learning curves, cost declines, price declines in innovation means we'll get a boom in innovation. The other side of that is there are many companies who, especially since the tech and telecom bust, and then again 08, 09, they've catered to short-term oriented shareholders who are scared. They've been scared ever since 08, 09, and they want their profits now, they want their dividends now. So these companies leveraged up, buy back shares, manufacture earnings, and didn't invest enough in innovation. They're going to face a lot of problems, and they will face the bad kind of deflation. On inflation, we do have a controversial call here. I think the prevailing wisdom is we have an inflation problem. This is not transitory. And I will say that the supply chain bottlenecks have lasted a lot longer than I would have expected. And the latest version of that is consumers running out and buying holiday gifts well before they normally would, because of supply chain issues that might prevent them from buying presents later. So we believe that the bigger risk here is deflation. And there are three reasons for this. Two are secular, one is cyclical. The secular reasons, one is good and one is bad. So we are experiencing today the biggest uplift in innovation. We're in an innovation age, the likes of which we have not seen before. And the learning curves associated with the technologies that Barbara mentioned up front, the learning curves are characterized by cost declines. And I'll give you some of those. We focus our research on Wright's law, which is a relative of Moore's law, but it's a function of units and not time. And so for every cumulative doubling in the number of whole human genome sequence, costs are dropping 40%. And we're at a very low base, so we're going to see a lot of cumulative doublings. For industrial robots, that number is 50%. For battery technology or battery pack systems, that's 28%. When it comes to artificial intelligence, we are learning that training costs, so AI training costs, are dropping at a rate of 60% per year. So these are massive deflationary forces. And this is disruptive innovation at its best and most prolific, really in the history of all time. The bad form of secular deflation is associated with the creative destruction associated with disruptive innovation. Now, we have seen since the tech and telecom bust, and then again, maybe even more so in meltdown, increased risk aversion in the traditional asset management world. And part of that was a shrinking of investment time horizons, and the demands for profits and dividends now, which we believe, to the extent companies cater to that short-term point of view, that many companies have not invested enough in innovation and are going to be disrupted or disintermediated. They bought back shares to manage earnings. So a lot of financial engineering and leveraging up and to service that debt now, if their products are going obsolete, and we think a lot of products are going obsolete, they will have to cut prices to these products. The third source of deflation, which this is the most controversial, cyclical, we're looking at the behavior of businesses versus consumers since really mid-2019. In 2019, the yield curve inverted and China-US trade tensions got worse. Businesses became risk averse and they stopped growing their inventories faster than sales. They cut back on capital spending. Then we move into the COVID crisis and they shut down. Then, of course, the government puts in place stimulus payments. The consumer saving rate hit 33% in April of last year. So consumers went to market. Really, it was to buy goods, which are only a third of total consumption. So they spent the year buying goods. They couldn't really buy services. And businesses have not been able to keep up with them. What we think is happening now is double and triple ordering, which will end up in, we believe, a significant inventory overhang next year. And that will be cleared by cyclical price cuts. Now, in terms of monetary policy, and this is where, and fiscal policy, this is where you and I discuss and debate a lot, Art. I remember after 08-09, I was sure that the monetary easing would unleash, and fiscal policy easing would unleash inflationary forces. And I was wrong. So velocity, which I know you consider only a residual, but velocity went down. So the rate at which money turns over went down. People were scared. And we know from the 70s, it is when velocity picks up and when consumers and businesses try to get ahead of price increases and interest rate increases by buying now that we see an inflation problem building and moving into wages as well. We are at a very important moment right now. Velocity is stabilized. It's ticked down in recent months. And I believe it will continue to tick down because what I just gave you was a deflation story, a secular deflation story, which, if we're right at how powerful this story is, will mean that velocity will continue to fall because prices are going to fall. And interest rates are falling. I think interest rates, you asked me the other day why I thought real yields were negative, 10-year yields negative. Do we really believe real GDP growth is going to be down negative for the next 10 years? I think there's a lot of mismeasurement right now taking place in the nominal GDP accounts. And if we're right, these statistics, having been born in the industrial age, do not account for the digital age. So that probably means that real GDP growth is higher and inflation lower, but it's very confusing. I will give you that because the markets are contradicting. In the crypto markets, we're seeing a correction. They are starting to succumb to what we're seeing in the equity market, which is this strike against technology, growth, innovation. We think that's going to be short-lived. The algorithms and the quantitative strategies, we believe, are going to be wrong once again. We're all in, and my conviction couldn't be higher. Well, today we have a very different point of view, once again, about what's going on out there. And so that's why we do these videos, and I will get into that in a moment. First, I'd like you to alert you to a blog that I wrote in mid-December. It's on our website. And it goes into why we believe that innovation is in deep value territory, and goes through and refutes a lot of what we believe are the myths out there about innovation. We believe that COVID-19, the coronavirus crisis, accelerated the shift towards the innovation platforms around which we have based all of our research. And I'm going to give you a few examples of that in a minute. I do want you to know that, of course, we've been through a very difficult time since the significant rotation from growth into value started nearly a year ago in mid-February. And I want you to know that we're in there with you between the company and ARC funds, which are more than half of my IRA, and the significant percentage of my total net worth. We're all in, and my conviction couldn't be higher that the innovation that has been evolving and was accelerated coming out of the coronavirus crisis is unstoppable, and the convergence between and among the 14 different technologies that we are researching, that convergence is underway now and is causing and will continue to cause explosive growth, really the likes of which we haven't seen in our lifetimes. And when I say explosive growth, I mean when it comes to those innovation platforms, they're going to cause a lot of problems for the underlying economy, the traditional world order. And I'll explain a little bit more about that in a moment. So what has happened is in the early stages of the coronavirus, when I was doing those videos, we had algorithms and quantitative strategies focused on just a few variables. They were at that time cash burn and cash cushion. And a lot of our stocks did not have big cash cushions and were burning cash, especially in the genomic space. And they were taken down by 75%, many of them, in a month, just in a month, 3 weeks to a month. And of course, that was the wrong answer. The algorithms got it wrong, and that there was a massive head fake, caused a lot of consternation for the quantitative strategies out there. Because, of course, genomics was a big part of the solution to a problem we were facing in the coronavirus. What has riled the market in the last week or so is Fed minutes being released suggesting that the Fed is going to become more aggressive at raising interest rates, perhaps sooner than many expected, maybe in the March timeframe. Now, what we believe has happened here is that the Fed, having suggested that inflation was transitory since the beginning of the coronavirus, was becoming concerned when it saw CPI inflation, headline inflation, year over year at 6.8%. And it does not want to be blamed for inflation being sustained and certainly not moving out of control. We think this is a bit of jawboning here. We think that some of the economic statistics that I'm going to share with you in a bit, the Fed knows very well. And those statistics suggest that inflation is indeed transitory. But on the off chance, and I'm sure there's a big debate going on at the Fed, there are going to be some Fed governors and Fed presidents who are looking at statistics and are citing some that are still on their way up. There are others who are going to be citing statistics that are on their way down, but they want to err on the side of hawkishness or being too tight right now, certainly from a jawboning point of view, because they don't want inflation to continue to escalate. We see M2 growth still around that 13% range, having peaked at 27% in March of 2020. So the deceleration is there, although it's leveled out at 13%. And what we think is quite significant is this concept of velocity, which means that money growth is faster than GDP growth. That velocity going down, we think is beginning to reassert itself, which would be anti-inflationary. Again, we have to wait for more statistics to make sure we're right on that. But we do think that M2 growth is higher than GDP growth, which means velocity is continuing to go down. If velocity were starting to go up, meaning the rate at which money changes turns over in the economy, if that were starting to go up, that would be an inflationary signal. We're not seeing that. In the crypto markets, we're seeing a correction. They are starting to succumb to what we're seeing in the equity market, which is this strike against technology, growth, innovation. We think that's going to be short-lived. We think that we're in a period of innovation that was the dream in the late 90s. But those companies were vaporware. They were based on nothing but eyeballs. We have real revenues. We have incredible growth rates. And if we're right and the economy has an inventory problem, then our growth rates are going to look far superior to anything you'd find in the value space. And we are really looking forward to that.